So next up, we're going to be looking at the property cycle, the property market. When is the best time to buy property? And also ultimately why cash flow is king, especially when you're looking at a portfolio of any form of size. Now, ultimately, property is cyclical. It will have supply and demand, peaks and troughs, boom and bust will come into it. Now, when property prices are increasing, everyone's very buoyant about property. Obviously, that pushes up the prices, not just from homeowners, but also investors. When property prices are reducing, people are very worried about property, or they're unsure about property, and you see that effect. So it is cyclical, it is human nature that's going to play into this supply and demand and ultimately boom and bust curve. Now, these are outside influences very often that will change the severity or the longevity of any boom and bust, things that we can't influence and can't change. Back in 2007, 2008, that was a financial crisis. It's hard to predict those sorts of scenarios. It's certainly hard to influence those sorts of scenarios. So you just have to try and understand what stage of the cycle you're in and understand what the right fundamentals are to try and buy properties. Now, there are ways that you can certainly try and anticipate this. You can look at recent trends or even historic trends. You can look at price movements in any given area. You can look at outside patterns that might influence the property market. The downside to all of these, and even when you consider certain indexes like the house price index, Rightmove has them, Halifax has them, look at prices on land registry, things like that. These are ultimately all types of kind of calculations that you can do. There's algorithms that you can use that will try and predict what the potential price of properties might be. The downside is that it doesn't take into account kind of human nature. So it doesn't look at those outside influences that could come as curveballs, that could influence the property market, could influence property prices, that you are not able to predict. So although you can anticipate it, it is still your human nature. A lot of these scenarios you can look at retrospectively and see and say, okay, well, maybe you could have kind of predicted that, but it's very hard to proactively kind of consider those impacts. Ultimately, it can also impact and impede your potential growth as well. If you're growing a property portfolio, but you're trying to wait for one particular part of the market to try and judge it, it might be years before you actually get that. And also you may not kind of predict it at that point in time. It's not an instant transaction, so it's not a case of saying, right, the 1st of January I'm going to go out and buy a property, and then you transact that same day. And then if at any given point in the future, let's say on the 30th of December, you want to sell that property, you sell it on the same day. You don't have that luxury. There will always be an element of time and always an element of an unknown, really, when you're buying and selling property as an asset. So trying to guess the cycle, trying to guess what part you're in, and really trying to ultimately hedge against it and predict it is going to be very difficult. The good news is that you ultimately don't have to if you look at and consider the fundamentals that make a property work in any cycle. One of the main fundamentals is cash flow. Cash flow definitely is king when it comes to growing a property portfolio of scale and of size. There's a Warren Buffett kind of statement that it's far better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. Now, primarily that translates to property quite well. Ultimately, you want to be buying wonderful properties, and if you can buy them at a great price, that's amazing. If you can buy them at a fair price, those deals can still work. Wonderful properties in as much as they give you everything you want from that particular deal. It gives you your cash flow targets, it gives you your income, your lifestyle, the amount of time you want to spend on those particular properties. All of that is achieved rather than just going out there and buying a property because on the paper it looks like quite a good price. It might not have the right fundamentals. So it's important, it's imperative to make sure those properties you're considering has inherent cash flow on those deals, especially if you're holding them as a long-term buy and hold. Even if you're doing developments, you want to make sure they're profitable. You want to make sure that the figures stack up and it gives you the right net profit at the end of all kind of costs. So you need to forecast and look at those deals correctly when you're considering them. So I wouldn't worry too much about the cycles of the market. Certainly consider it, certainly plan it as part of your growth plan and your portfolio plan, but I wouldn't try and predict what part of your market in and try and guess it and just wait until it achieves a certain level of the market before you then buy, because it's very difficult to predict. Not only that, but by leading with cash flow first, you shouldn't have to predict it. You should have that inherent kind of buffer effectively on any given deal that you're considering. So whether there is changes that are outside stimulus that impact the property market that you can't change or you can't really kind of guess or legislate for, things like legislation changes, things like tax changes, government changes, all of these things that can really impact your potential investment, if you have the right cash flow and the right fundamentals with that deal, then you should be solid over the longer term. Now, there are fundamentals that you need to consider outside of cash flow as well. Now, to help break these down for the fundamentals, we have 7 golden rules effectively, or 7 golden criteria that we look at for any given property deal. And I'll put the link to like a checklist and a visual image of what that particularly looks like. But out of those 7 things you need to consider, the area is going to be one of them. So you need to buy in the right locations. Tenant profile is another. You need to make sure you have the right sort of tenant profile. Whatever tenant profile it is, just ultimately it's the fit between what you're trying to achieve and certainly the location of the property, whether that's student market, professional tenants, local housing allowance, companies, whatever it might be, make sure that is a fit for that location and that property type specifically. Not only that, but also rental yield. What sort of rental target should you be achieving for that property and location? That will certainly come down and assist the cash flow element later on. In addition to that, you want to look at things like exit strategy. How hard is that property going to be to sell at any given point in time in the future? All of these things will combine to give you the right criteria and fundamentals. Can you add value to that property? Is there potential for the refurbishment to add value to the deal? Can you buy at the right possible price? Can you sell at the right possible price? Again, all of these factors play into giving you the right fundamentals that if you look at these combined with cash flow, you can buy in any property cycle, in any property market, and ultimately the deal should work. Whatever strategy you use, whether it's buy and sell, whether it's buy and hold, consider all of these fundamentals, and that should give you some great standing going forward to grow your property portfolio.